Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, shutdowns, countdown, counting Congress scrambling for a last-ditch deal to keep the lights on. The UAW increases strike locations, now going into their third week against the big three automakers. It's the end of an era for one company as the month ends for this type of business. We'll tell you more. When the stock market ended today, it was not just for the end of the day, but for the month and for the quarter. We'll tell you what happened. So what will a government shutdown have on the stock market? And will October and the fourth quarter be better than September? Tonight, we're going to be talking with the head of investments for Louisiana at J.P. Morgan's private bank, Terry DuFrene. It's the end of the month for trading as the dollar is higher, bond yields are higher, oil is higher, tensions are higher. But the stock market, well, for the month, that's one thing that's lower. I'm Andre Laborde. We've got these stories and more. It's Friday, and it's time for Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. It's Friday, September the 29th. Well, today is the last trading day for the month for September, and it couldn't come too soon. The government ended its fiscal year this Saturday, coming up at midnight. And at that time, Congress will either have to extend the debt ceiling on the government credit card or shut down until. Our national debt has grown now to $33 trillion. And if a shutdown does occur, all federal employees that are non-essential are furloughed. Now, they all will be paid in full back pay, whether they worked or not, once a deal is settled. Our national debt has grown to $33 trillion and growing by $6 billion a day. That's $10 trillion more than just before COVID hit in March of 2020. Well, this debt is contributing to the raising of interest rates that now, this week, if you want to buy a home, a 30-year mortgage is now over 7.6%. And analysts are predicting it's going to be reaching 8%. And that interest rate today is up almost 8.5% since the beginning of this month on September the 1st. Now, to put this in perspective, if you were buying a $400,000 home, which is the average home today, with today's 7.6% rate, you would be paying an additional $920 from what you would be paying 2 years ago. Now, these rates are crushing the home market, with pending home sales for August now down just over 7%. And for the year, it's down almost 20%. These prices are not only stopping home buyers, but they're keeping home sellers in their place. So, to fund this $6 billion a day in government spending, we, the government, is selling Treasury bonds in years from 2 years all the way up to a 30-year bond. The higher the debt we're accumulating, the higher the interest or yield we have to pay to entice you, me, and other countries to buy our debt. China and Japan are two of the largest countries buying our debt. As the interest is growing, we have to pay more for you to buy treasuries. So now the question is, do we kick the can down the road and keep the government open by extending the credit card of the United States, or do we try to solve something? Well, there are two arguments in both of those camps. But if you think what they do in Washington doesn't affect me, you, others, if you'd like to finance a new car, financing is now close to 8%. And used cars are now over 15.5%. If you hold a balance on your credit card, your interest rate is now close to 25%. So just as you know that you just can't pay the interest on your credit card, the government shouldn't just be able to pay the interest on the national debt. Actually, we're not able to even pay all the interest. We're just extending the debt ceiling, and that's what this is all about. Well, how did our money do for the week? Both the Dow Jones and the S&P were lower for the week, and all stock sectors were lower for the third quarter. The NASDAQ had their worst quarter in a year, and it was their first negative quarter of 2023. And this week, the Dow Jones closed down 1.3% for the week. The S&P 500, they were down 0.7 of a point for the week. And the NASDAQ, they did close up for the week, but almost reaching 0.1 of a point for the week. Stocks were down for September, going all the way back since 1928, according to the Dow Jones market data. The S&P for 500 for September has been down on average 1.1%. Now, that's the bad news. The good news is that on average for the fourth quarter, which, by the way, starts on Monday, until the end of the year, when August and September were down for at least 1%, which they were for this year, the S&P 500 was up, on average, almost 8.5% by the end of the year. Well, we'll see if this year is the on average. So will the ongoing UAW strike or government shutdown have any effect on market volatility? And what about our debt to GDP? How sustainable is it? Let's talk to Terry DuFrene. Terry is the head of investments and managing director for Louisiana at JP Morgan's Private Bank. Hi, Terry. Welcome to Wall Street Wrap-Up.
Thank you, Andre. Great to see you.
Well, Terry, September's over with. Was this a normal September for you?
Yeah. It's just short story is I got started in this business in 1987, actually 86. And so 87 was my second year in the business. And you got to remember that was the year of the crash, when you had the October 19 crash down 22%. So anything compared to that is roses. But all kidding aside is that, this normally happens. I mean, volatility is normal in markets, and it typically tends to happen in the fall. September, but more October is notorious for having sell-offs. But if you think about it, just that's a normal course of business. If you go back and look at some of the past periods of time, over the last, say, 3 decades, we usually get a 14% pullback in any given year. And even beyond that, there are some years that are more than that. Again, we know how badly 2022 was, being down, quite a bit for the major market averages. But even with that, Andre, if you go back and kind of pull back the lens, is that you say 75% or well over 32 of those 43 years, the market has had a positive return. So to us, you do see, these occasional periods of time when the market does sell off, but it does eventually turn back around and respond to fundamentals, and eventually the market does turn positive. So it's just part of the pain you've got to live by being an equity investor of having to deal with these temporary pullbacks.
As you just said, September being normally a down month, and August was also a down month, which was expected. February is usually also the third month. Are you drooling right now for the rest of the year, or are you concerned about other factors?
No, I think if you think about what it is in front of us, we've clearly had the Fed make a statement by coming out and telling us that they're going to be very mindful of all the data as it comes in, and will raise rates by another quarter point if needed. Most odds are that they will. The thing that's changed, though, Andre, is that you're looking into 2024. And the expectations were that they would probably start to have some rate cuts. And before the Fed meeting, there was a probability that we're going to have about at least 4 rate cuts in 2024. As we all know, that would be stimulative for the economy. They've come out and clearly said that it probably won't be that much. In fact, now we're looking at only maybe 2 rate cuts. So we are going to have to live with an environment of higher for longer. In other words, rates are going to stay persistently higher than they have been in the past. The idea of having, treasuries, well under 1%, 2%. I think those days are going to be, a relic of the past, and we're going to have to look at rates, being somewhere around where they are, maybe a bit lower, but definitely not as low as they have been in the past. So what does get me excited, though, Andre, is if you think about valuations, and I know we like to spend a lot of time thinking about how expensive the market is, but if you pull out, as we all know, the Magnificent Seven, we all know who those stocks are, then you're going to become much more to a very reasonable price-earnings ratio. In fact, I'm going to give you a data point. You think about the market being up for the year, that's going to be the market cap-weighted S&P 500. But if you go ahead and look at the equal-weighted S&P 500, that index is actually about flat for the year. What we're saying is that the rest, the other 493 stocks in the S&P 500 hasn't done nearly as well as the Magnificent Seven has done. And so that tells me is that, no, we aren't buying into an expensive market. So I think we do get a pullback. Yes, I clearly will look at it as a buying opportunity.
We still have 2 more meetings left to go for the Federal Reserve, for November and one for December. Right now, we're between 5.25% to 5.5% in interest rates right now. Do you think that they'll have another increase for either of those two meetings? And I'll also say this too, Terry. I mean, if they do you think 25 basis points would even mean anything?
Well, that's a really good point. So you kind of think about what we've done in the last 18 months of how much they've raised rates, over 500 basis points. Truly unprecedented, rate of increase over, in that short period of time. So yeah, I think another 25 bips or another 25 basis points wouldn't be meaningful. So yeah, I don't know that it had the same impact as the first 25 basis points had, or the first 50 basis points had. But let's remember is that Chairman Powell did say this could be very data dependent whether they raise rates or not, and likelihood that you start getting those rate cuts. In fact, we're thinking you may get your first rate cut in March of 2024.
Well, I'm thinking of certain things that are in the news right now. And right now we're looking at possibly a government shutdown on October the 1st. We're looking at the UAW strike that's continuing, and no telling how long that's going to be going. October 1st starts the first payment for student loans.
Right.
So with data, as you say, the Federal Reserve is data dependent. With events that are going to be coming up for October, for right now and October coming up, are those type of areas that do you think the Federal Reserve may say, well, this may slow down the economy more, so we will drop rates? Or would that even come into their thought process?
I think you forgot one, and there, four. There's also oil prices, and there too.
You know what? You and I work well. It's you're 100. You're not 50% right. You're 100% right. Plus oil prices.
Yeah. So let's address each one of those one by one. So the government shutdown, right? So that truly is problematic. I'm going to give you a couple of numbers here that maybe could cause you some worry. If you look at right now, the federal fiscal year ends this Saturday. And right now, the way it stands is that we're running a deficit of about $1.7 trillion, and that's about 6.5% of GDP. So that number by itself is pretty worrisome. If you go ahead into next year, the numbers get even worse. You look and see what it could actually turn out to be is that we're expecting a deficit next year of about $2 trillion, and the debt to GDP could be well over 100%. So those numbers in itself, to me, are worrisome. So I think that you look at those as being more of a catalyst for change or a catalyst for why investors may be hitting the pause button. The government shutdown in itself, while it may make a headline on the day it happens, the past 22 times that they have shut the government down where they had some kind of continuing resolution conflict is that the market quickly forgot it once the resolution came about. So yes, I think this could be a headline or two for a few days until they get it resolved, and once it does, this could be back to normal. Moody's, the last holdout that does have still a AAA rating on U.S. government debt, is also thinking about lowering that credit quality too. And we all know that that does have the effect of making us pay higher interest, because if you have a lower credit quality. So that is something that is worrisome in itself. Not the fact that a government shutdown may happen. I think we'll quickly forget about it once it gets resolved. I think you ought to pay more attention to the debt, the size of the debt and what it could mean by way of deficit to GDP.
But is that Moody's downgrade, that would be because of the $34 trillion that is being owed, not because of the government shutdown?
Well, it could be. I think it's going to be a factor in there, Andre, because it's just a willingness for us to pay our debts. Mm-hmm. And I think that the credit ratings need to do their jobs, which is to look and see, okay, what is the ability and the willingness of the government to pay their debt, as it comes due.
Like you said, for the last 22 times since 1976, right, not only have they've always come out of it, whether maybe a week or 2 weeks or whatever, but all those that were furloughed, they got their back pay.
Yes.
So if they stayed home, they didn't get paid on that day, but they got paid for that time while not being at their government jobs.
Yep. And that's probably likely is going to happen again. Mm-hmm. You talk about the auto strike. There's this data point. I may get the numbers wrong, but I remember is that in 2023 alone, there's been almost 250 labor actions that's happened throughout the country. So this is not unique to UAW, but certainly the one that gets all the headlines. And I think it's more of a sign of the power of the worker, right? And the worker has felt that they've been underpaid for some time. And we all know what happened with Starbucks. That's another example, one where we had some strikes out there. But there is now the occasion where the workers have seen the profitability of some of these companies, and they want a share of those profits. So this has been, if you remember going back to the great financial crisis back to 2008, 2009, when the auto companies were really on the ropes and the government stepped in to help them out by giving them loans, is that that was some of the concessions that were made, is that the workers did give up some of the benefits that they were getting at the time, and I think that they now feel that it's payback. And so the auto workers strike is something that's headline worthy, something that I'm certainly looking at. But it also just portends to a greater trend, is that the whole idea about electric vehicles, being a bigger part of where people are spending their money when it comes to new automobiles. And we all know that EVs take lesser parts, and there's just less work to do there. And I think that the workers have got to be very careful of how they parlay their bets into concessions from the auto companies. Is that eventually the EV is going to take over from the combustion engine, and that is going to create a whole new work dynamic. So something for both sides to be aware of, but I think there is going to probably be some concessions. In fact, I know that one of the auto companies is already making some of those concessions already. So that's the auto worker strike. So I think it is something that I've got on the top of my mind. I think it is inflationary because of wages that could be going up. But the auto workers themselves aren't a big part of the economy as they were, say, back in the 70s. You also mentioned student loan repayment. Yeah, that is something to look at. That's billions of dollars that no longer will be discretionary income. That's going to be now used to go ahead and pay down student loans as they come due. I saw a number that the average the average pay is going to be about $200 to $300. So I think that some of the consumer discretionary stocks, some of the larger retailers, certainly people that sell to the end user, I think that they're going to have probably some challenges on a go-forward basis. But broadly speaking, $300-400 billion, that's not going to be spent, in the economy. It's going to be used to pay that debt. As part of a larger economy, multi-trillion-dollar economy. I just don't see it as being meaningful to kind of shortchange what the equity market's going to do. And then last of all, we did talk about oil prices. Again, we all know that oil as a percentage of the economy is much less than it was, say, back in the 70s, but it's still is meaningful when you go to the pump and fill your car up. In fact, I went the other day and I filled it up and it was $90, yeah. and I couldn't believe it. And I told my wife,
luckily you're not in California right now. That's over $6, right?
No kidding. It definitely puts a bite, into the budget. That's being driven by pure supply demand dynamics. We all know the challenges that the fossil fuel business has got here in the United States by way of getting funding and actually just getting approvals to get new wells drilled. The whole thing around that as far as that supply. And couple that with what OPEC did, the OPEC plus countries being very adhering to the cutbacks, production cutbacks, that is creating much more of a supply challenge. And now demand is picking up. We definitely have seen more and more people hitting the roads to use gasoline and diesel. And so that is a pure recipe for a higher price. And so I think.
Do you see a $100 barrel of oil coming up?
I think we could. I think that by year end, when we look at our forecast, we can certainly see a $100 barrel for WTI by year end. We definitely think it's a possibility.
What about, Terry, that we look at the bond market with Treasury bonds, and normally 30-year Treasuries and 10-year Treasuries pay more than a 2-year or a 5-year. But right now, the low year 2-year is paying over 5%. Right. You're looking at 10-year and 30-year, they're paying 4.5%. With the points you were bringing up before, like we're talking about the $34 trillion in debt. We're talking about the interest rates that are having to be going higher with the Federal Reserve. Does that have something to do with the Treasury Department, that they're offering over 5% yield on a 2-year and over 4.5% yield even on a 10-year and a 30-year?
Yeah, so you've got more supply coming online, and there definitely is more treasuries being printed to go ahead and fund the government. What's interesting to note, though, Andre, is that you've mentioned it as inversion of the yield curve, right? When you get paid more short term than you do for longer term. Typically, it's just the opposite, right? You take a longer term risk with a 10-year Treasury, so then you with a 2-year Treasury, therefore you should be compensated by that extra time that you're putting into the Treasury but 10-year by having a higher rate of interest. It's actually inverted. It's been inverted ever since really the Fed has started raising rates into last year. And you're seeing right now the 10-year at 4.5%. Call it the 2-year, call it 5.25% or so, and that is a very much of an unusual feature, and typically it's a portender of an upcoming recession. I think what's happening though, Andre, is that short end is clearly being driven by what the Fed is doing, and when the Fed raises rates, you get really a lift in interest rates in the short end of the curve. On the longer end of the curve, though, being where it is today, at 4.5%, that tells us that we're going to see again that higher for longer. And we all know that the 10-year Treasury is a determinant of a lot of things, including home mortgages. And right now, if you think about home mortgages being well over 7%, that is causing some pain in that sector where home sales, whether you're talking about existing home sales or new home sales, have all fallen off dramatically. So that is a direct result of what the Fed has done with higher interest rates. And I can tell you that from my perspective is that clients are interested in those higher yields, for equities and being 4.5% Treasury money.
Terry, if you've got a client, let's say a client of yours calls you and says, Terry, I've got some cash on the side. In fact, I'd read a report a couple of weeks back where there's something like over $5 trillion in cash reserves. So there's a lot of money on the sides in there. And I'm curious, is it fear of getting back in? But if they go, Terry, should I get into equities because now may be a good time to buy, because there is some fear and trepidation, or do I just go ahead and put it into a 2-year 5% Treasury, or do I go into a longer term and get 4.5%? What would you tell them?
Yeah, so a lot of our clients are sitting in cash, and they're quite comfortable sitting in money market funds, getting, call it 5.5%, 5.25%, 5.5%. So that's very comfortable at the moment. But a couple things you got to remember is that sitting in cash does not give you the opportunity to participate when the market rips ahead, as we know it will happen. Just to kind of give you a data point is that over the last 3 decades, the market's up, call it about 1,700%. So it just shows you the power of staying in the market and being invested. So I think that I would definitely encourage my clients to be looking at equities, particularly if we have another further pullback in levels. That's one thing. And I also want my clients to be looking at bonds. I think that, again, for the first time in many, many years, it feels good to be buying longer duration bonds. I've seen some corporate bonds, yielding 6%, for 10-year paper with a 2-year call protection. So they're out there. Those higher yields are available to you. And last, another thing that I'm advising clients to do coming out of the money market funds is look at private credit. Private credit is money that is used to fund a lot of M&A activity, a lot of private equity transactions. And banks are somewhat reticent to make new loans right now because of rates, where they are. And we're trying to be mindful of that. And so therefore, a lot of the private lenders have stepped into that. And we see private credit funds being a way to kind of capture that. Right now, I'm looking at some private credit funds that are getting north of 10%. In distributable yield, and that's something that's very attractive to my clients as well. So yeah, it's a tough conversation. You're very comfortable getting 5% plus in a money market fund, but we all know that's not a long-term solution for you to be for somebody who's got long-term horizons, for their investment portfolios.
With the interest, with the interest rates the way they are right now, sometimes with interest rates, certain sectors of the stock market will be hit more, and certain sectors will be helped. Are there certain sectors that you like more than others? And offhand, I'm thinking of, like we were talking about, oil, probably hitting $100 a barrel. Technology, with normally the higher the interest rate, the more technology gets hit. But that also could be a good opportunity. What do you tell your clients?
Yeah, so I think you look at some areas, so like REITs, for example, would be a beneficiary of lower rates because, again, you can get those real estate projects refinanced at lower rates, so that would be helpful there. The number one beneficiary is going to be growth equity, because when you start doing any kind of dividend discount model or anything that calls for factoring rates, when you raise rates, that calls for lower terminal values, but when you start lowering rates, that does increase your target prices, your terminal values. And we all know that the higher PE stocks are ones that are going to benefit from lower rates into the future. So technology clearly will be one of those that will continue to benefit from that. Also see consumer discretionary being a beneficiary of lower rates too, because again, that would make for lower funding costs, lower interest rates. Like on housing could be a beneficiary of that. Something else to think about though, Andre, is that we haven't mentioned this yet, but we also like industrials. And industrials are one that are going to benefit from this, and the Inflation Protection Act, or the Inflation Reinvestment Act, that was passed by Congress a couple years ago, because there is, as you know, just billions of dollars being spent right now on all sorts of projects that industrial companies should continue to benefit from.
Terry, we've got a lot more to talk about, and next time we'll have more to start part two. I hope you come back.
I will. And Andre, I always appreciate the opportunity. Thanks for your time.
Thanks, Terry. Hey, if you have a question, maybe a comment about the show, well, we want to hear from you. Make it concise, make it pithy. Write us at andre@benecapital.com. So let's take a look at the markets heading into next week. And because of a government shutdown, possibly, the unemployment rate and the job numbers, which are expected for this week, may be coming out or may not. But before we go, on this day, what small tech company launched 25 years ago? Well, we've got the answer, and it's coming up. On this day, what small tech company launched 25 years ago today? Google. In 1998, when they first started, they were processing 10,000 searches a day. Now, they've grown to over 8.5 billion a day. In fact, Google went public in August of 2004. So if you would have invested $10,000 in 2004 when they went public, they would have had over a 6,000% return. And your $10,000 would now be worth over $60 million today. Not a bad return on your money. So let's have a wrap up on Wall Street. Netflix started in 1997 with a DVD rental business coming to an end tomorrow. Now, with streaming being the way people view their movies, there's still 6 Netflix employees sending out DVDs by mail that ends tomorrow. But they said you won't have to, if you've got one of those DVDs, you don't have to return it. Keep the DVD as a souvenir. And that's a wrap up on Wall Street Wrap Up. Well, the markets took a beating this month and rising interest rates with our debt to GDP. So are we expecting higher rates? What's the stock market expected to go into the fourth quarter? And is a recession still on the table? Join us next week when we'll be talking with John Stolfus. John is the chief investment strategist for Oppenheimer Funds with over $260 billion in assets under management. Where does he see our fourth quarter looking? That's John Stolfus next week. And that's our show for this Friday, September the 29th. Our thanks to Terry DuFrene for being with us tonight. Always, though, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll be here next week. Remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde, and also remember, money doesn't sleep. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.